everyone. Welcome back to the Relai Bitcoin Podcast. I am really excited to have Lyn Alden here today. Very special guest. Thank you very much for taking the time, Lyn. How are you?
Thanks for having me. Happy to be here.
Awesome. So let's kick it off. I don't think you need a lot of introduction. Obviously, you're into Bitcoin, into investment, into research. You're an investment analyst. You're also an engineer by trade, and you're one of the most intelligent people in the world. That's at least what I think. I've listened to like so many podcasts of you. When you went to Present Pish, Peter McCormack, all these huge podcasts, and really glad to speak to you today. What I'm interested in is mainly why are you, like someone like you who can, makes his money also with advising big companies, institutional investors. You could make just a lot of money with the time you spent actually educating retail investors. So you have a very big investor newsletter that has a huge reach, and you spend a lot of time educating retail investors how to do investment and about assets like Bitcoin and so forth. Why are you doing this? Like, why are you passionate about the retail investors?
I think the short version is that I've grown to like it. I've grown to have a passion for doing it. And it's always easier to do something if you really like what you're doing because it doesn't feel like a chore. And I just generally noticed that there was an unaddressed part of the market, which is basically to take institutional type of research and then to put it into plain English so that, fairly sophisticated retail investors can make use of it. While also the funny thing is institutional people are like, finally it's in plain English for once. And a lot of them actually read it as well. And so it's kind of that sweet spot where you kind of hit a broader audience than you otherwise think you would. And in general, if you do things just for money, it's usually not very rewarding. It's easier to burn out. You're often not going to go as long in it. Whereas if you're doing something you really enjoy, you stick around with it longer. And it's funny because when I was in school, like when I was younger, I never really liked writing. I was always into the math and science.
You did not like writing.
I did not like writing. It was my worst subject, and I just didn't like it. And I was not like I read, but I was not like a huge reader either. I just wasn't like, it was not my area. I was more into math and science. Um, but I think it ended up in hindsight, it's because I didn't like what I was writing about. Like if I got assigned a report to write about, it just felt like a chore. Whereas if once I found something I really enjoy, which initially was investing, and then more broadly became macro and technology and trends in general. If I really like what I'm writing about, it's really enjoyable. And in many ways, my style of writing is kind of investigative, where I see a lot of confusion around a subject, and I start to get emails about a subject, and I'm like, okay, this is clearly there's like it's complicated, people are confused, and I'll go ahead and try to outline this whole thing. And what I also find, if you don't have to, like, there's that whole old saying like if you want to learn, teach,
Yep.
which sounds kind of backwards, but basically if you are interested in learning something, it's really easy to get, say, like 80% of the way there and then kind of hand wave the hard 20%. You're like, it's good enough. I get most of it. But if you really want to understand something deeply and you're about to like teach someone else, you have to, like, you're basically forcing yourself to figure out that other 20%. And that's what I generally find, that when I go to write something, I'm like 80-90% of the way there, and I have to figure out that last 10 to 20% and really nail that if I'm going to publish something that people are actually going to read. And so that it's actually really helpful for my own process as well. And so it's kind of this like nice feedback loop that I just find it really enjoyable, and people seem to find it useful, so I keep doing it.
Wasn't it like I think it's a quote of Einstein who said, like, if you can't explain something, you haven't understood it, right?
Exactly.
And so that's a very nice exercise. And I think it's a very big need out there in the market to get. I mean, there's so much content about investing. Like, there's YouTubers, there are so many content creators. Some of them are good, but also many of them are really mediocre or bad. And I think it's a big demand for kind of retail investors, just people on the street, basically, to get this information. And a lot of the investment information that you actually need to create a good portfolio and to invest successfully in the market for decades and build kind of a wealth is just hidden to the public, and it's only very exclusively accessible through like portals like Bloomberg, for example, where you pay 20K or more per subscription per year to these institutional investors, to these hedge funds, and like it's crazy what kind of access they have and information, insights they have that just normal people don't have. So I think it's a super important topic that you're addressing. But you also have to kind of monetize this, right? It's like how do you do it from a business model kind of view? Are you able to monetize this huge reach that you now have in retail from retail investors as well, or is it just something that you profit then also from your personal brand that you're building that you can use for your client work?
So yeah, I do monetize it. So in addition to all my public free research, I have a low cost research service that is purposely priced so that it's accessible to a retail investor audience. And basically you make it up in terms of number of subscribers versus on a per subscriber basis. And again, I don't wake up and figure out how to maximize revenue. I wake up and figure out how to maximize accuracy, maximize readability, maximize content,
Mm,
solve interesting problems, write about interesting problems. And generally, if you're doing all those things, the money follows. Now, it doesn't
mm,
follow automatically. I mean, sometimes you have to know a thing or two. Like when I first started out, I would focus on, say, search engine optimization, how to get a
mm,
post to rank well before I had any sort of like following. And so that was like a trait that I built up. I also just generally, I would read how to write in such a way that you get people to keep reading so that they become familiar with your work.
mm,
So you don't want to completely ignore the marketing and the monetization side, but it certainly should be secondary to just putting out, like just the best thing you can put out,
mm,
and because then it's much easier to tweak a couple things, the other things follow. So for me, it's certainly still able to be lucrative in that avenue, as long as you're just not trying to optimize for it. You're
mm,
just trying to optimize usefulness.
mm. So as a retail investor right now, looking at the markets, I mean, it has probably not been as turbulent and unsecure to be investing in the markets for decades as right now. You have all these influences, like the war is still going on. We still have the aftermath of COVID. We have very uncertain times in terms of interest rates. Central banks is kind of waking up. 10 years they didn't do nothing. It was like 0% interest rate. Money was basically free, and now the interest rates are going up at a rapid rate. So there's so much uncertainty out there, and I feel like many retail investors are just lost. And that's also why a lot of people still hold a lot of fiat money. For example, in Switzerland, we have a high percentage of like a high savings rate. On average, Swiss people are saving around 20% of their income every month, and we have high income. So there's a lot of money that is safe, but it's safe on fiat. Two-thirds of this money is actually just lying on fiat bank accounts, which is crazy because we don't have high inflation, like super high inflation, like for example the US or other European countries, but we still have like 3.5%. So you still lose a lot of money just by inflation. And obviously, then there's also almost no interest rates. There's a cost coming to it, banking fees. But people just rather have the money on the bank account where they lose slowly in value than to invest it in the market. So what would you say to these people to kind of try to take their uncertainty away, or how should retail investors now behave in or invest in these markets?
I think it's about time frames. And so in a short-term time frame, sometimes fiat cash does make a lot of sense. I mean, it was one of the best performing assets last year, for example. If most things are going down a lot, then something that goes down a little bit, is flat nominally and goes down a little bit in purchasing power, as a section of a portfolio can be useful, right? If you have a specific framework that tells you, most things are not going to do well, we're say economically slowing, all these things are happening, then, an outsized position to cash or cash equivalents can make sense.
Mm,
Obviously, longer term, the story is very different because cash is programmed to lose value over a multi-year period, year in and year out. And so basically, if you're doing that, you're kind of just making donations, you're paying tribute to seniorage. And it's obviously worse in some countries than others. Basically, whatever you're holding, you're in some way strengthening that monetary network and you're enabling that monetary network. And so, if you say disagree with the actions of a specific government, if you're holding their cash, you're helping them. Kind of like if you're
Mm.
holding shares of a company, you're helping them. And then number two, you're getting slowly bled out. And a lot of people don't um, like there's just not a lot of financial literacy in schools and just in general, where they don't necessarily know the difference between nominal returns and inflation adjusted returns. And so
Mm.
they see a bank account and they see they're getting, X percent, yield back, maybe very little, but it's positive. And they say, well, at least I'm just growing slowly. And they might, of course, they usually know inflation exists, but they don't necessarily put two and two together and say, okay, what is the actual number that I'm losing in purchasing power per year? Assuming these inflation statistics are reasonably accurate, and then looking at my interest rate and saying, what am I actually losing every year?
Mm.
And if people did that, if rates were shown in like inflation adjusted values, and it was just marketed as, hey, if you put your money in the bank account, you'll lose, 2 to 7% per year on average, and but it won't go down, double digits, or whatever the
Mm.
case may be, then it would be a lot less attractive to people. So I
Mm.
think some of it's literacy, some of it's we're also programmed where, if people lose 20%, that's a lot more painful than losing 2% a year for 10 years.
Yeah.
It's just how we're designed for like loss aversion.
Yeah.
And so I just think the only way around it is people have to do a lot of research and education to see, okay, what do I want to invest in over, say, a 5-year period? And what is that going to look like in inflation adjusted terms, not just nominal terms?
Mm.
Hey everyone, this is Rafael from Relai. I want to tell you about Relai Private. It's our exclusive service for private clients, family offices, and small or medium-sized companies looking to buy or sell large amounts of Bitcoin. As a Relai Private client, you have a full team focusing on your needs. A dedicated account manager guides you every step of the way. You also get personalized 24/7 support and gain access to exclusive reports and industry insights created by Relai. If that sounds like something you or somebody you know should check out, click the link in the description or head over to relay.app/private.
But the problem is, as you said, most of people don't have this financial literacy. I mean, even in Switzerland, a lot of people around the world think, for example, that in Switzerland we are very financially literate. We're not. We're well educated, but and some of us have 9 years, some of us have 15 years or even more of school, but there's not one lesson of finance, personal finance. It's just not. Even though we're like a financial hub in the world, whatever, there's just really no financial literacy. So people are asking themselves, what should I invest in? Right, so they maybe now know that, okay, there's high inflation, and as you said, they maybe think, okay, I do now get a 0.75% sometimes in interest rates, but the inflation in Switzerland, for example, is 3.5% anyway. So it doesn't make any sense. And then a lot of these kind of YouTube investor influencers say, oh, you just put everything into ETFs. You have an ETF savings plan, and then you make, I think in the last 50 years, on average per year, you make 5%. But again, that's also, is this the right way for just people that don't want to spend a lot of time researching the market? Or should they do stock picking? Should they, go more into something like Bitcoin, which is a neutral kind of digital savings technology? What is your kind of take on that?
So I think the person who doesn't want to spend a lot of time should be reasonably diversified, right? Because if they own let's say they all go all in on Bitcoin, and Bitcoin has one of those 80% drawdowns, they're going to sell it, right? If they're not like deep into the Bitcoin research, that if they haven't done like 1,000 hours of research on it, they're going to freak out and panic when it gets cut in half, and then they're going to lose value. So for most people, I think that some degree of diversification makes sense. You want to have your liquidity needs met with cash to some extent. And then, I personally find equity investing, really useful. That can be either individual stocks, or if I had less time, would be ETFs. But then I would want, hard money as a notable part of that portfolio, which in my view today does include Bitcoin. And so I think it really depends on what someone's trying to optimize for. I think you can make a case where it's almost like a barbell approach, and that's kind of the way I'm approaching it, which is I focus on investments that provide pretty good income, and an income that grows with inflation on one hand, and then also have like a slice for like say Bitcoin, some gold, things like that that are kind of these bare asset alternative monies that have a much slower supply growth rate on average than you're getting with fiat currencies. And the Bitcoin, yeah, the added kicker that is also, arguably, if the thesis is correct, it's arguably under owned. It's still in its adoption phase. And so in addition to being, like a finite asset, it's also basically still underappreciated, uh, uh, understood, and it's kind of growing into whatever total addressable market that it's eventually going to reach.
There's like an emerging savings technology, as Saifedean Ammous is saying. The problem is that it's still so volatile that most of the, even professional investors don't see it as that, right? They don't see it as this long-term 10, 20-year or even more long-term kind of savings asset or inflation hedge or whatever. They see it as a very speculative asset. That's also why it behaves like tech stocks right now. It just behaves like an alternative asset. And so I think that, for example, what you do, this whole education, and also what we do at Relai, trying to educate people aloud with this podcast, with other content and blog and everything. This is super important. But what do you think? Like, how long does it take for people to kind of understand and accept this new asset class as a more kind of long-term digital gold savings technology alternative? How long do you think it's just for most people still speculation?
I think it depends on their background. If someone has a computer science background or kind of like a, say, Austrian economics kind of sound money type of appreciation, though one of those two avenues generally will probably help you understand the value proposition quicker than if you're coming at it, from a very different background. But basically, I do think it takes, a couple hundred hours to really get far enough in that you really know what's going on. And the challenge is, so anything that seems to the outside like a speculation can become a lot less of a speculation if you're really knowledgeable on that thing. Like, for example, there are deep value stocks that on the outside, someone will say like, "Hey, what do you think of this stock?" And I look at it and it looks like super risky, and it's like I'm like, I have no idea. I'd have to spend dozens of hours going into their books. But somebody who has gone into the books and then also researched the industry might end up viewing that as a very low risk investment. They're like, it's super cheap. The market is mispricing X, Y, and Z. And here's kind of the range of outcomes, and almost all of them are favorable at these price levels, and they can develop a thesis for why that makes sense. And so for them, they don't view it as a speculation, even though a market that hasn't spent at least an hour on it does view it as a speculation. And I think Bitcoin's kind of the same way, because you have to understand, one, you have to understand money to some extent, which is just not well understood, the topic of money. Two, you have to understand protocols, right? You have to have some understanding of the history of protocols, things like that. You also have to understand some degree of code. Why is this different than Dogecoin, for example, right? The average person would have trouble explaining the difference. That they would just say, well, Dogecoin's kind of like Bitcoin, but it also has dogs, so it's better. Um, and so basically someone has to go into, well, okay, here's why node size matters. Here's why bandwidth matters. Here's why the parameters and the liquidity and the network effect of Bitcoin are different than something like a Dogecoin, right? And so that all of those avenues take time. Then you want to go and investigate the risks. Okay, what have been the bugs in the past? What is a hard fork, and why are there sometimes different factions in the ecosystem that want to take it in different directions? And you kind of go through, you basically should be able to outline all these different avenues. And for a lot of people, when they've done all of that, then they start to view it like a savings technology. But even then, they still have to acknowledge risks. They have to obviously acknowledge volatility and say, okay, this is savings technology for, X% of my net worth that I can afford to have, go down by 80% sometimes, but that I expect to go up long term. And I do think it's just going to take a lot of time, because something like a cell phone, when it comes out, can get adopted very quickly. The problem with getting adopted something monetarily is that there's going to be a lot of leverage placed on it, and you're going to get these bubbles inevitably. There's no way to monetize from 0 to 10 trillion,
It's not going
right?
to be
As like
linear.
yeah, it can't be linear. Whereas like a technology adoption can be linear, or just smoothly exponential. Whereas financial adoption can't be, because you can attach leverage to it. And so you're going to get that. If anyone looked at a logarithmic Bitcoin price chart, you're going to get exactly that kind of crazy higher highs and higher lows, but in a very volatile fashion because you have a technology adoption curve combined with pockets of leverage and euphoria, right? No one like if you look at most financial markets, you get euphoria and then you get depression, you get euphoria, depression, whereas you don't get that in, say, like, when smartphones came out and they started to become more and more popular. No one like euphorically gets a smartphone and then it says, oh, this was a terrible choice, and they go back to analog, they go back to the prior phone, right? And then they go back to smartphone. They don't, it's just more like it's a slow grind into more and more adoption, whereas you don't get that in something like Bitcoin. And so that's inevitably going to be challenging to people. And I think the process is that it has to go through multiple cycles. They have to go through the first cycle where they liked it, then they dismissed it, and then they're like, oh, it's dead now, and then it rises again, and then they have another justification for why this time is not going to be a takeoff, and then it crashes again, and then it goes up a third time, and then they're like, okay, clearly I'm missing something, and then maybe they'll actually put time into it. I think it has to go through multiple cycles over multiple years.
Yeah, I think that's super important to understand that this is a tech innovation, but also a financial innovation. It has a lot to do with society actually understanding it and behaving a certain way and accepting it. And like, this is going to take so much longer. I think, as usual, we as human, we underestimate what something, we overestimate what something can be in the short run. We underestimate what can be in the long run. And so for us, again, the people that really have spent the hours and hours, probably thousands of hours, we kind of, for us, it's pretty clear that at one point, it's hard to say when, but at one point it will be kind of this overarching global asset that is established as a savings technology. But obviously for many people that don't put in the hours, it's really hard. But I also don't think that the majority will ever understand, like, because the majority of people even now don't understand money. Like, if you go out to the streets in the US, more than 50% still think that they can exchange their dollars to gold. They still think we're in a gold standard, whereas we're not for 50 years or more now. So I don't think we will ever get to a point where a majority of the people will understand Bitcoin. So do you still think, two questions, do you still think we will get to a kind of hyper Bitcoinization, or like Bitcoin being in the majority of the portfolios at least? And two, do you trade these kind of cycles? So now when we understand that there are these cycles, even though we believe in it on the long run and we believe that Bitcoin will be 100K, 500K, whatever, do you dollar cost average, or do you still trade these kind of cycles?
Yeah, so multiple questions there. First, to touch on your prior point, I do agree that most people will not understand Bitcoin at a deep level, just like they don't understand the current system at a deep level. Most people, for example, if you pay with a credit card, they can't tell you the complex handshaking that's happening between the banks along the way, how many different entities are involved. Um, you know, just to take the four big credit card networks, Visa, MasterCard, Discover, and American Express, most people don't know the difference. And for example, Visa and MasterCard are not banks. They're just like these technology rails that banks issue cards on, whereas Discover and American Express are banks, and they're also these payment rails, right? And then you have basically acquiring banks. You have there's so many different like handshaking aspects for how that works. Let alone if you go into like repo markets, like basically how's fiat working at the wholesale level, basically between banks and things like that. It's just a very complex market. I remember like there's this crazy diagram that shows how the dollar system works between the Fed and all these things, and it almost looks like an Ethereum roadmap, like this crazy, it's like this Rube Goldberg machine, and I remember I think I tweeted something like this whole dollar thing is like way too complex, like give me Bitcoin instead, and it's one of those things like if you had to just learn the dollar system from the root from scratch, and someone was like trying to sell you this idea, it would take a lot of time to spin up on that. And so I do think basically Bitcoin only has to be understood by the marginal that will then shift over. And then once it hits critical mass, it's just like, well, okay, this other thing's devaluing and this thing's not devaluing. And so it just kind of works itself out over time. On to the prior point. So I don't set out to trade. For Bitcoin, I dollar cost average in. I think that's how the majority of people should consider doing it. Basically, just determine what allocation makes sense to you, and just kind of stick with it and have like say a 5+ year view. Preferably longer, but I know realistically, like a 5-year thesis for what this kind of is playing out. for portfolio management, because I do, I provide a lot of investing research. I focus on this full time. And generally what I'll do is if something is becoming very euphoric or it's become a very oversized allocation in the portfolio, I will generally trim that. And so, when I have, say, securities that are proxies for Bitcoin, maybe they're Bitcoin mining stocks, maybe they're MicroStrategy, maybe they're one of the ETFs or trusts that hold Bitcoin. If I'm doing that specifically in a portfolio context, and let's say I have 5% of the portfolio in them, and then they go up to 15% of the portfolio because they've gone exponential in like an 18-month period. What I've done in the past, like during this prior bull run, I said, okay, it's getting euphoric out there. Dogecoin's going vertical. This is tripled in terms of my asset allocation, so I am going to sell into the strength and basically, lock in the gains you've made, because that allows us to then maybe redeploy when now we're like in a bear market. And so I do risk management in that regard, because I do have, a lot of people reading the research and they don't want to be caught off by, massive drawdowns. And, I never try to predict, okay, here's the top, here's the bottom, let's actively trade this. It's more like, depending on if it's euphoric or depressed, if it's way above kind of like volatility adjusted price bands or below them, I kind of just make note of that and I say, well, okay, when it's euphoric like this, the probable range of future returns is now diminished over, say, a 2-3 year period. Whereas if it's super cheap, it's okay, now the probable range of future returns is better. And so I do manage the volatility in that sense. But I, for example, I never touch cold storage Bitcoin. That's a different animal.
That's a good point I wanted to touch upon as well. You give advice to a lot of institutional investors. Obviously, they're happy to take your advice on what to sell, what to buy, when, what not. Are they also taking your advice onto cold storage? Is this like, our businesses or institutional investors already thinking about cold storage, or do they just want to have access to Bitcoin via an ETP, a structured product, some kind of paper wrap of Bitcoin that they can easily book into their portfolios, like very traditional? Or are they really thinking about, okay, I want to have like 1% of my portfolio in physical, quote unquote, Bitcoin, as they do maybe with physical gold? I don't know how these big institutional investors work.
So it depends on the size. So if you look at, say, like high net worth individuals, family offices, that kind of thing, a lot of those do get interested in cold storage Bitcoin if they, come to the appreciation of the thesis that Bitcoin is likely to continue to appreciate in price and value, and is it an important network for the world. For actual institutions, like very large institutions, generally due to regulatory issues, holding the keys is not really something that they can realistically do. It depends on the country in question. I mean, for example, the US and Swiss laws could be different in this regard. But for example, like I would talk to money managers, very large money managers, and they would say, okay, they initially explored holding the keys, but then there's regulations against them being a custodian if they're also managing someone's investments. And so they say, okay, we have to use some sort of vehicle to get exposure. In addition, I mean, most of those at the end of the day are trying to make, basically returns within a walled garden, like within the fiat system. They're building a portfolio in a brokerage, in this financial setting, and they want it to grow in price. And so they're not thinking in terms of like, okay, I want to own the actual keys to the Bitcoin, or I want to actually own gold in like a vault outside of the bank system. They're not doing that. They're kind of like, is Bitcoin going to go up or down? Is gold going to go up or down? And I want price exposure to that. So yeah, realistically at an institutional level, I think you're going to be pretty much in a custodial environment. And it's really kind of the small business, high net worth family office and below, down to the retail level, where I think you're going to get more interest in cold storage.
How large is the demand from SMEs, for example? So it's pretty clear that like retail investors are in growing demand for Bitcoin. They want to invest more in Bitcoin. There's the institutional investors like hedge funds, but family offices that want to get in, even corporates, some first corporates and even nations interested in Bitcoin. But I think SMEs is something that it's a very big potential market that is not really... people don't talk about it yet. So in Europe, for example, Relai, we just launched Relai Business. So we opened up for, like, with our very easy fiat to Bitcoin on-ramp also for businesses, because there are 25 million small and medium-sized businesses in Europe, a growing number of them led by Bitcoiners. So obviously they have an interest to not only individually in their private wealth, but also with their companies own Bitcoin, right? And so I think this is a tremendous opportunity. But for these people like SMEs in Europe, it's super, super hard to buy Bitcoin and hold them in a regulated way. Do you see a big demand there? Is this something that the industry maybe really oversees yet, and that's something that has huge potential?
I think there's a big market for that. I also think there's a big market for RIAs, like investment advisors. That's still a very underserved market. But focusing on small, medium-sized businesses, basically, a lot of people, when you're running those companies, right, you want to have cash savings, you want to have some sort of, optionality. But if you're sticking it 100% in fiat currency, you have this melting ice cube problem. And so there is like a pretty big opportunity. I think if someone, if the owner of that business or the owners of that business have done the work and they say, okay, this is likely to do well over a given 5+ year period, then, if we have a certain percentage of our savings that we don't plan on touching for years and we want to have that optionality, then I think that Bitcoin is a good argument for that. And then there's a very large market for where that can be useful. And, basically the advantage there. So first of all, the downside of a very large company getting into Bitcoin is career risk, right? So the people making the decisions, the CEOs, the CFOs, they're usually not the majority owners. They usually are like basically hired by the board, representing the shareholders, depending on how big of a company we're talking about. And so they're focused on reporting good quarterly results, good yearly results, maybe at most like, rolling 2-3 year periods. They want their options to do well. They want to not lose their job. And so it's really about, it's not really about taking what they would view as risky decisions. I mean, most of them haven't spent 500 hours studying Bitcoin. And so they said, well, I'm not going to put part of the balance sheet in this, like, speculation from their view. And another thing is that even if they have done a lot of work and they say have Bitcoin on their own, like in their personal savings, there's usually a problematic accounting treatment. Now, I think this is starting to get resolved, and over time, I think this will get better. But a lot of accounting, the way it works is like if it loses value, you have to like book that as a loss. But if it appreciates in value, you can't. And so if you're a small business and you're only reporting to yourself or a few others, and you can say, okay, this is how it's actually working. So regardless of what the accounting might say, this is actually the numbers there. The Bitcoin is appreciated to this amount. Whereas if you're a publicly traded company, you're more stuck with those those types of public numbers, and it can mess up your earnings smoothness, your earnings quality, and things like that. And so generally, it's not a surprise that the entities that put a lot of money into Bitcoin in public are ones where the CEO owns a lot of the company and is very influential. So in MicroStrategy, Michael Saylor owns a very large percentage of the voting of that company. So he's been there for decades. He's practically immune to career risk, and so he's able to make those decisions almost like a small business that is hard to make if you're just a hired CEO with 1% of the shares. Same thing for Block Inc., formerly Square. Jack Dorsey has a very a big impact on that company, very big stake. They had a small Bitcoin allocation. Elon Musk with Tesla. Now he's all over the place. He's not as consistent as those other ones, but he is in that position where he can make these kind of sizable decisions and put that on the balance sheet. And I think that the advantage of small and medium-sized businesses is that the leaders are in that kind of position. They have either own it or they own a big chunk of it, and there's a small number of people that can decide this is the best interest of our company.
Yeah, that's and also, I mean, in the next 10 to 20 years, millennials and Gen Z, but mainly millennials, who are already now the biggest consumer group, will become the biggest investment group or group of money management through obviously their own portfolios, but also because they will be in control of the companies. They will inherit a lot of money. They will gain control of these companies. And now it's not surprisingly probably because many like old white men are in control, in charge of the leadership boards of these organizations. But the more time passes, the more these guys get retired, the more millennials are getting into control. Do you also think that this will kind of shift, that a case like MicroStrategy will not be viewed as very exotic, but more and more millennials who have understood, who are basically digital native and very Bitcoin oriented, they have understood that at least a portion of the treasury should go into Bitcoin, so that basically it is an almost inevitable way that more retail investors and also more business investors will have a rising allocation into Bitcoin, because obviously if you look at the surveys of different generations and how they view Bitcoin, it's Gen Z are very open to Bitcoin, millennials very open to Bitcoin, and then the baby boomers and all the other generations, the older generations, it gets less and less. But that obviously means that every year we move forward, more people and more companies basically are going to invest in Bitcoin, and because Bitcoin is this scarce asset or fixed asset, the price will appreciate over time.
I think that's part of it, and I also think another big chunk of that is kind of the health of the fiat currency system, right? So it's not like we see, for example, a lot of companies with older management sticking their balance sheet in gold, right? Because over the past 40 years, even though fiat currencies lost value, for a while, interest rates did compensate you for that loss in value. And so they had a relatively stable environment from, say, the beginning of the 1980s all the way to, into the 2000s. And it was in the 2010s we started to get, after the global financial crisis, that's when a lot of these rates became, below the inflation rate on a persistent basis. And whereas millennials are kind of growing up in that environment. I mean, most of what they know is, fiat currency, especially if they're financially literate, they know that fiat currency just basically yields below the inflation rate. And so you just slowly get devalued over time. And there are occasional periods like right now where central banks are trying to aggressively hike interest rates. But the problem is that there's so much debt in the system that it's very hard to repeat over the next 40 years what we did over the prior 40 years, which is basically, you had positive real rates for most of that time. You kept getting higher and higher debt to GDPs, more and more financialization. I think we're in a different era now. It's like a different part of the very long-term cycle. And so I think just the more over time that fiat currency keeps grinding on with negative real rates, maybe for a year here and there you get the briefly positive real rates, but I think the majority of the time it's going to be negative real rates.
Yep.
And it just becomes more and more obvious that you want to be in other assets.
Yep.
And it's also, large companies have more options in some way because they often will decapitalize themselves. They'll spend out as dividends, they'll spend out as buybacks, and they'll have, like, say, some debt, some cash. They don't want to generally have very, very large cash positions. And so they have more ways to manage that. Of course, that reduces their optionality in the future to some extent. But they can also, issue shares to make acquisitions. They just have more flexibility with their capital structure. Whereas if you're a smaller business and you actually want savings, then I think it's going to become increasingly useful, especially to people like, on average younger, but really anyone who takes the time to dig into the technology and the monetary history and to understand, okay, this is actually interesting and this could be something that's useful for my business in a practical sense over, say, rolling 5-year periods going forward, because I don't think the fiat currency system is going to get any healthier realistically than it is now.
No, most likely not. I've looked at this chart of the debt, how the debt is rising the last 100 years, and especially the last 20 years. It's like really going crazy. It hits the limit of the Fed again. Like they will probably increase the Fed. There's almost no reason for a limit anymore, no rational reason. It's really stupid. So there's these huge amounts of debt that can never ever be paid back anyway. And now they're raising the interest rates. How quickly can you see, from an economic point of view, effects of that? Because it can't be. This cannot work. In my mind, it doesn't work if you have huge amounts of debt and this debt was free for 10 years, and then all of a sudden it's getting super expensive. Like the debt is all of a sudden from 0%, it costs you a couple, like 3-4% now every year. But probably not like we would not feel these economic effect immediately, because you would only, like businesses who have a lot of debt, for example, or countries that have a lot of debt, they would only need to pay it in a year, and maybe for 1 year they can pay, but not for 2 years, and so they will need to kind of shrink and lay off people, but later, right? Are we already seeing these effects of the interest rate hikes from the central banks, or is there still a lot of chaos to come?
So we see early signs, but I think a lot more is to come, and partially depends on how much fixed rate debt is in a given jurisdiction. Some jurisdictions have a lot more long duration fixed rate debt versus shorter duration or adjustable debt. And so, for example, in the United States, the majority of homeowners have these very, very long duration fixed rate mortgages. And so basically the first area that really felt a lot of this pressure was the housing market, but it doesn't affect the majority of homeowners. It affects people that are buying and selling houses right now,
Wow.
especially if they're buying or selling them with with a mortgage attached. Basically, if someone's trying to sell their home that has a mortgage and then move and then get another mortgage to get another house, or someone's a new buyer and needs a mortgage to do it, that's where you've had almost a significant collapse in activity. On the other hand, the average homeowner did not see their mortgages go up because they're locked in. The same is true for corporations. They have, on average, multi-year duration debt. So around the margins, quarter after quarter, some of that comes due and potentially has to be refinanced, but it's not as though their entire debt level went up at once. And then even the same is true for governments. I mean, in the United States, the average duration on Treasury debt is 5 or 6 years. It fluctuates. And so when you jack up interest rates for a year, it is pretty front loaded. So a lot of those T-bills basically quickly got repriced at these higher yields. But anything, these longer duration, the majority of the debt is still just quarter after quarter, year after year. If you stay at these types of levels, that will get repriced over time. And so it is one of those things where even just staying as tight as they are now gets tighter over time as more and more of that leverage, gets refinanced at those rates. And basically to quantify it in the United States, I mean, if you have a little over $30 trillion in debt, every 1%, average weighted interest rate on that debt load is over $300 billion a year in interest. And so about 3% on average gets you $1 trillion in interest. 5% would get you like well over $1.5 trillion in interest. And then the problem is you're issuing more debt to cover that interest, and you get in kind of a fiscal spiral. And so I think that's what we see in a lot of developed countries today, which is you have very, very high debt to GDP ratios. And over the past, 10, 20, 30 years, this was offset by steadily declining interest rates. And so you didn't have interest expense going up, especially as a percentage of GDP, because all of that was offsetting each other. Now you're in an environment of you still have deficits, you still have rising debts, but interest rates are sideways to up. That's catastrophic for public finances for a lot of these developed countries. And so I do think that this is going to be a story that plays out for years. And basically, if they want to, fight inflation, they can try to be hawkish, but then it really starts impacting all those finances. And then it ironically becomes like in the United States, we're so financialized that if stocks stop going up, if real estate stops going up, then a lot of the tax revenue dries up too. A lot of the capital gains, a lot of the economic activity slows down. It's almost like the tail wagging the dog. It should be that the economy drives financial markets, but we've gotten so big in the financial sense that financial markets in some ways drives the real economy. And then you can actually get lower tax revenue from that, and you get even larger deficits. And so it kind of feeds on itself. And I think this is going to be a story that plays out throughout this decade, unfortunately.
It almost feels to me like what I learned in the books, in the economy books in university, was that you can evaluate a business in terms of the numbers, like revenues and everything. The better revenues, the better profit, the better team, whatever, all these characteristics, the better it is, the higher is your value of the business. And then there's a minimal effect of economic influence, like, for example, the interest rates and the inflation and so forth. But mainly you evaluate the business, whether it will go up and down in price, and you calculate the net present value of it. But now it feels like 10 years later, the real world feels like everyone is just waiting for the Fed. whether they are going up or down with interest rates, whether they are printing money or not, and then the whole stock market just behaves accordingly, right? So it seems like the frameworks we as kind of investors, retail investors, need to use to invest in these markets are totally different. We just basically just need to understand and interpret the signs and the indications of the central banks, because it doesn't really matter anymore how good the business is, really. Would you agree to that?
Yeah, that's the challenge at the end of a major macro cycle, is that everything becomes about the macro. And so basically, if it's like one of those things, if you're denominating everything in units of a currency, and the currency itself is undergoing transformations or wild pivots, then obviously everything else upstream is going to get heavily influenced, perhaps even more than those business decisions. Now, there's still a big difference between, say, different sectors, right? So, for example, last year, if you were in the right sectors versus the wrong sectors, you did way better than other sectors. So individual company analysis still matters, and I actually also find that it the way that I do research is that looking at individual companies also informs me about the macro, and then the macro can influence me on what types of sectors or what types of companies I might think are going to do well, and so those kind of feed on each other. But yeah, it's certainly in an environment where we've had free money, essentially, that has distorted how not only how you do stock selection, but also how companies themselves perform. Because, during this decade of hyper growth companies doing very well, right? So NASDAQ stocks doing better than Dow stocks, but not even NASDAQ, more like ARK style stock, these like hyper growth unprofitable companies. The reason those worked is because capital was nearly free. So the valuation for a high growth company was almost infinite, and they would constantly issue more and more equity to pay their employees and just to keep raising capital for their growth, and they could undercharge on their product or service because they didn't need to be profitable, and then therefore they could grow faster because they're charging less than they should, so they're able to disrupt something that exists now. And then the problem is, when you actually have a cost of capital, all of that feeds on itself negatively. So now,
not sustainable.
so if you had 0% or 1% treasury yields, maybe someone was willing to pay 30 times sales, not earnings, but sales for that company. But now if interest rates are 3, 4, 5%, they say, well, okay, so now I'll pay 10 times sales for this company. And so they can't just do the thing where they're constantly issuing equity anymore. And then they say, well, okay, now we're deeply unprofitable and we can't issue a lot of equity, so we have to raise prices and actually try to be a sustainable business. But now that we've raised prices, growth has come down because that prior growth rate was artificial in the beginning. And so now all aspects of that company normalize, and you kind of see that the only reason that whole thing was working was essentially a bubble. Whereas like a normal profitable company, I mean, there are a lot of like healthcare companies out there, or a lot of like traditional banks, or a lot of like, say, energy pipelines and things like that last year were just almost unchanged because they're almost immune to the macro environment because they're just like low valuation profitable companies that didn't really experience the bubble on the upside, and therefore didn't experience the bubble on the downside either. And that's actually kind of what happened in the dot-com bubble. If you look at US equity sectors, tech obviously had this crazy run up and down, whereas like real estate investment trusts and like energy stocks and like banks, like they didn't really on average do much in the late 90s or the early 2000s because they were kind of like, what bubble? We didn't see a bubble. It was mostly in tech. It was also weirdly in consumer staples. So like stocks like Coca-Cola were trading at like 50 times earnings in the late 90s. And of course, Coke continued to do well for the next 15 years, but its stock price was so highly valued compared to its underlying. It just, the stock price went like sideways for like over a decade as the fundamentals caught up to it. And so those kind of distortions are just very macro driven in many ways.
That's exactly the same thing that you could observe on the startup and venture capital market, right? To be an early stage startup raising venture capital in the last 10 years was quite easy and fun. If you as long as you were growing, you didn't really have growing in terms of traction, like active users and stuff like that. Doesn't even mean making money. Like a lot of companies were just growing super fast and raising all these hundreds of millions and just basically burning it for growth, but not sustainable. There was no unit economics. There's no revenue. I mean, there was revenue, but not profit. So this was really the same. How do you see this now? Since mid last year, this really changed. I feel like also VCs are not overpaying like 100x revenue for early stage startups anymore, and not paying these super crazy valuations anymore. But it really came down to a multiple of between 5 and 10, so very rational again. And it's really, they are looking again for like stuff like qualitative stuff like company culture. Are they really thinking big? Are they thinking long term though as well? Are they taking care of the people? And also quantitative stuff, obviously, are they making revenue? Are they close to break even? Stuff like that is now has now become from the perspective of venture capitalists way more important, I feel like. And that's also kind of why I think we were doing a bit better at like Relai when it came to venture capital than other startups that have done really well in the past when capital was basically free. How do you see that? Because you're also obviously involved, for example, in ego death capital, I'm sure in other stuff as well when it comes to venture capital. How do you see this playing out in specifically in the venture capital and startup landscape?
So I think the short answer is like you actually have to do due diligence now. I mean, there's a whole decade where you can kind of just like write checks and things would keep going up. Now there's actually a lot of due diligence because you actually have to examine an idea and figure out, okay, what is the timeline to this thing getting profitable?
Mm.
What if they can't issue equity forever? Uh, how long until they're a sustainable business? And startup investing, of course, has significant risks. I mean, you're exploring new technology, new business models. You're always going to you know, be optimistic at the seed stage, right? Because you're not quibbling over exact, how much time sales we're going to pay for this like seed stage
Mm.
thing, but you have to be very diligent about the probable range of outcomes and make sure that you're protected to the downside so that you don't have too many catastrophic mistakes in your portfolio. Especially in the later stage venture capital, there's just been so much excess and so much malinvestment. And then it's even gotten worse in the broader crypto space because you have the idea of like venture capital funds can distance themselves from the underlying performance of their company. So one thing about venture capital is that you're pretty tied to the actual fundamental results of the company, right? So you invest in a company, they grow, and if they want exit liquidity at some point, generally the avenues are either they are successful enough that they go public, or they're successful enough that they get acquired by intelligent people at a larger company that say, okay, this is going to complement our business. This is a good business we want to add on to ours. We have synergies here.
Mm.
Sometimes you can change shares in the private market, but it's not super liquid. And so basically, you have to be right about the fundamentals of the company. Whereas what you've seen in crypto VCs is faster time to quote unquote exit liquidity, which basically means dumping on retail investors, where they can invest in a quote unquote technology, have 1 or 2 year lockups, and then dump their tokens on retail, investors, basically that are unregistered securities. And then the venture capital firm has made money,
Mm.
whereas the project then stagnates and dies and didn't really do anything over say a 5 to 10 year venture period, and then you kind of repeat on the next cycle.
Mm.
And so it has. I just think this is a very late stage environment that that we've been in for kind of growth assets in general, venture capital and unprofitable hyper growth tech, especially. And I think that there's just going forward, there's gonna be a lot more diligence there. Another way
Mm.
of characterizing it is that each kind of major investment cycle has like areas of excess and then areas of underinvestment. And so, for example, in the 1990s, there's obviously an overexuberance into tech, and there was not a lot of investment in, say, new energy development, real estate, things like that. And after the whole tech bubble blew up, the 2000s, they say, okay, what's scarce? Well, energy, infrastructure, real estate. So they go into that. And of course, by the end of the decade, that became excess, right? So everyone's just like, bringing more and more commodities online. Everybody's talking about the rise of the BRICS nation, so the insatiable growth of the emerging markets, and people were getting over leveraged on real estate, and then that all blew up. And then, the 2010s again was overinvestment in tech, software as a service, just basically all of that stuff. It's just, if you're a company, you have tons of different subscriptions to different types of software. Um, and I think the 2020s are kind of reversing again and say, okay, what's scarce? Energy infrastructure. In some areas, certain types of real estate. I would say basically just good money, but the Bitcoin ecosystem in general, that kind of thing. So whereas like SaaS and just cloud and a lot of the stuff that was really successful the past decade, that's very crowded. It's very overinvested. It's obviously useful, but it's not like you're going to find bargains, and it's not like there's a dearth of capital. Whereas there is a dearth of capital in boring things like chemical manufacturing or infrastructure development. That's the kind of thing that I think is going to do well, because it's not where there's just a bubble in a lot of the stuff that's kind of traditionally venture. So I think it's kind of like the late 90s in that regard.
Yeah. This is really eye-opening, because it's easy in the end. People are just looking for what is scarce, and that's what they want to buy. And then the more money flows into it, the less scarce it becomes, because everyone wants to produce this, and then people are looking what's scarce now. And with Bitcoin, the funny thing is that it's always going to be as scarce as it is. There's no way we can produce more of it. That's another argument why on the long run it's going to do well. So last question for you, until I need to let you go. I could talk to you for ages. What is and I ask this to everyone, so you unfortunately need to answer this as well. How much of your portfolio, like what in percentage terms, are you investing into Bitcoin?
So it fluctuates because of Bitcoin volatility, but it's a sizable double-digit percentage of my assets. I mean, it's not single digit. It's gone up partially because I made a sizable allocation, but then it's also appreciated faster than the average asset in the rest of my portfolio, because I've been holding it for years now. And so yeah, it's a sizable double-digit percentage, I would say. Probably the peak was like, when Bitcoin was near its high, it was probably a little higher than it is now, because it was just large. Now that it's shrunk, it's gone down somewhat, and I expect in the years ahead it'll probably go up a lot, even if I'm not, say, plowing a ton more into it, because I already have a very large position. I am still dollar cost averaging, but I've generally established the position that I'm happy with, and now my goal is just to kind of let it ride as long as I view the network as the fundamentals keep improving, and I don't see anything in sight that would really change my thesis in that regard.
You know what? I'm going to do the same. Thank you very much. This is super bullish, and this has been very inspirational and very insightful. Thank you very much for taking the time to talk to me and to our community, and have a great rest of your day. I hope to talk to you soon.
Thank you. Thanks for having me.
Cheers, Lyn. Thank you.